Hi, good afternoon everybody. A warm welcome to you all to the webinar organized by GemAtlas today, which is on the forex and risk mitigation for the gems and jewelry industry. We are very thankful to Mr. Maulik, Shah and Almus for organizing this webinar for us. Now I will hand over the presentation to Mr. Maulik Shah to take it forward from here.
So good afternoon everyone. My name is Maulik Shah, the co-founder and chief executive officer of Almus Risk Consulting, and we are the risk management company mainly into the field of managing foreign exchange risk for the corporates. My own background is I was earlier working as a CFO of Rosy Blue India for almost 10 years, and in 2012 is when started this venture. So as part of chief financial officer of the company, I was managing the currency risk exposure for the group, and which is this experience is what we have converted that into a proper setup to look after various corporates who have an exposure into the currency market. So this presentation is mainly focused on gems and jewelry industry, which is where my previous experience comes from. Combine that with the foreign exchange market experience. Intention of today's presentation is to share with you one, about the foreign exchange market, and B, what are the specifics, nuances of managing the foreign exchange risk when it comes to gems and jewelry sector in particular. So I'll start with the general overview on the market, and before I begin the market presentation, just one comment, because this has been my experience whenever we talk about the foreign exchange market or foreign exchange risk management presentation. The immediate first question which most of the participants would have is where dollar rupee is going to go. So before even the speaker starts the presentations, the audience is already waiting for that answer to get, or rather that question to get addressed. So in today's presentation, definitely I'll share about the foreign exchange markets, the views, the way market is looking like. But more specifically, it is about the gems and jewelry industry, where how do you manage your currency risk exposure, and what are the best practices which you can adopt. And these are all time-tested practices which one can really adopt. So as you're participating in this conference, apart from seeking out for an answer as to where dollar is going to go, my invitation to all of you is to really look at which all practices you can adopt for your own businesses, irrespective of the size of your business. These are practices which will really help you, forward you, and that's really the background that I wanted to create before I start the presentation. So thank you once again for your participation. I'll start my presentation. The content, as you can see, broadly divided into general foreign exchange market. We will look at the how the market has evolved over a period of time. Then we'll come to gems and jewelry specifics. There is a very brief information about the gold hedging. As depending on the time that we have, we will talk about that, and what Almus as a firm can do, or what services that we can offer to help you formalize or put the systems and process in place to manage your currency risk. So let me take you through the foreign exchange market. Now, what are the different factors which has a bearing on dollar rupee market or dollar rupee movements? Some of the factors we all know, they are like exports, imports of the country, the capital flows, which are like external commercial borrowing, foreign direct investments, NRI remittances. Then there are FII flows, which are into equity market, and that all is governed by general market sentiments, fundamentals, and there are a lot of other factors which influences the FII flows into the country. Also, over a period of time, India as an economy has internationalized. We are connected with the global economy. So whatever happens in the global market also has an impact on Indian economy and in dollar rupee in particular. There are unpredictable cycles of depreciation and appreciations. The other factors which are important is the central bank world over. How do they view the currency market volatility? And the point that I want to highlight here is, all of us know since January we have seen a market turmoil. Now there has been a huge volatility. Dollar rupee moved up from 66 to almost 68.5. Sometime in the end February, so almost a weekend before the budget, the market was at the peak of the panic. and we had one major event on that weekend, and that was the G20 meeting. The next day, which was a budget day on Monday, since then, if you really notice, the dollar rupee market has turned from a peak of 60.5. We are today almost at 66.5. Now, point which I'm making is that there are concerted actions. These are all not officially announced, but the undue volatility in the currency market is closely monitored by the regulators world over. And that also becomes one of the key factors that not just influences dollar rupee, but also the global currencies. And that impacted not just dollar rupee, but euro dollar, GBP, yen, each and every currencies across the currency markets. So that's one major influence that we have on the currency. Dollar rupee today, I would say, is a globalized currency, because it's not just traded or participated within India. There are participants across. So we have seen a participation, and very active participation, from the overseas investors, the hedge funds, through the non-deliverable markets. So most of you may know about NDF market. NDF market today is one of the highest liquid market, and the volumes traded in NDF markets are far beyond what is traded in the local market. So, and what I have highlighted here is just a list of some of the factors, and it can go beyond that. So these are all the factors which really impacts not just the dollar rupee, but across currencies and even the commodity markets. The chart that you can see here, it starts from sometime in April 2013, when dollar rupee was at 53, and it hit the peak of 68.83 sometime in August-September, and since then we have seen September was the month when we had the new governor, Mr. Raghuram Rajan. Now, if you really observe this chart very closely, we have seen a huge amount of volatility in the year 2013, and since then, since the new governor took the charge, September 2013, post that, we are almost 2.5 years. There is certain way in which dollar rupee market has moved, and what we see on the chart is a reflection or a communication to the market that the market regulator, which is like Reserve Bank of India in particular, has a greater influence in the market today, and the RBI is in a better position to control the market from what you can see it on the chart. So if you really see, what has happened here is that consistently there is a gradual weakness in dollar rupee, and there has been those peaks where there has been an intervention, and these interventions are all regulated interventions. Interventions have happened on both the sides. So if you really see the band, the height of this channel is about 3 to 4%, and since 2013-14 till date, dollar rupee has really moved in this broader band, which is close to about 3 to 5% move. Now, obviously, as a market participants, or as a market players, or as a businessman who is exposed to the currency risk, there are chances of panic and greed, the fear and greed, because when it hits the peak of the channel, the market sentiments are so euphoric or so panic that we may view that dollar rupee is going through the roof. And at the same time, when you see the bottom of the channel, there will be a huge euphoric tendency that dollar rupee is now going to go down. It may go down to 60s and 50s. Now, this chart reflects the reality. This is how the dollar rupee market has behaved. The point of communication here is that as a market participants, we really need to be present about what is it that is behind this market movements. And if you really see closely, talk to any businessman, what is it that you expect from dollar rupee, or what is your view about dollar rupee? Possibly most of the businessmen will have one opinion that we are not in particular concerned about the level of dollar rupee, but the undue volatility needs to be something which is reduced. So dollar rupee moving in a band of say 2 to 3 rupees or 5 rupees in a period of 6 months to 9 months, possibly the business community would be comfortable with. But if it really gives you a movement like the one which we saw in 2013 is where the cause of concern is. And RBI has actually ensured that this is really regulated. It is moved in a very defined band, and that is what we have seen it. So today at 66.5, we are possibly in the lower end of the band, and which is where we are seeing a consistent buying over last 7 to 8 weeks since 66.10 has been hit for the first time. Dollar rupee has really got the support. Reserve Bank of India has been buying. One indication of Reserve Bank of India buying is clearly the increase in the Forex reserves, which is almost today now $360 billion. So if that is an indication, possibly we could be closer to the bottom end of the range, and dollar rupee can start moving up. Now, while we expect dollar rupee to remain stable over a period of time, for dollar rupee in particular, the currency is a carry currency. 1 year premium is almost 4 rupees. Now, too much of a stability brings instability, because if dollar rupee is really not doing anything, there will be a tendency to keep shorting or keep selling dollar rupee just to get the carry. Now, that is what exactly is the tendency that RBI tries to balance off by way of a gradual depreciation or a gradual weakness. This chart, it's an historical chart. As I said, possibly none of you who we are involved into our working capital cycle are actually concerned about the level of dollar rupee. But what really matters us most is how dollar rupee behaves between point A to point B. Our cycle is close to about 6 months, so we may be concerned about the movement between point A to point C. Now, that is exactly what needs to be managed. What dollar rupee will be after a year possibly is least of the interest for the business community. What really matters is how dollar rupee is going to move between the working capital cycle, which is 3 months or 6 months, depending on the manufacturing cycle. Now, the charts that I am going to show now, a couple of charts, these are all charts that indicates how dollar rupee during the year has moved. So the numbers that you see here is the difference between the high and the low in a particular year. And this indicates, like in 2013, dollar rupee moved almost 16 rupees, 15.9. And since then it has been maximum 5 rupees or 6 rupees. Now, this kind of a volatility keeps coming up. Important thing is how are we going to manage this volatility. Same thing if you really see the Euro INR as a currency pair. We saw almost 22 rupees movement in the year 2013, and then 10 rupees and 11 rupees. But still 10 rupees, 11 rupees is substantial movement in a year for someone who is really exposed to Euro as a currency. This reflects GBP INR movement. Saw the peak of 26 rupees in a year. Last year we saw 14 rupees. So the volatility, the range between the highs and the lows are going to continue widening or narrowing down. And we need to really be extra cautious about how are we going to manage our currency risk. This is the JPY INR range. So what are the challenges? What are you as a corporate are faced with? Because there are a lot of unpredictions. I mean, you can't really predict where the dollar is going to move. There are too frequent changes. There could be a sudden change in the trend. There is a global economy which has its own challenges. The low demand in the world market. The monetary policy not really having much of an impact in spite of monetary easing by most of the central banks. Now, these are all the factors which influences the world financial market, and that has an impact. It has an impact on your core business. It has an impact on the way you do a business. And that's really the dilemma that corporate faces. Do I buy? Do I sell? Or do I hold and do nothing? Now, let's come to the exposure identification. So when we talk about the currency market, any corporates involved into the cross-border transactions are exposed to the currency market. Now, the general exposure that one is aware of is that anytime you have an import and export transaction, which is what we call it as a trade transactions, that's one point of foreign exchange exposure. There is also another point of foreign exchange exposure where you have an external commercial borrowing or any foreign currency funds of a long term in nature that comes in the country. Now that's is an exposure on the capital side. So mainly there are three questions that we need to address First is what to hedge. What is our exposure? And I'll come to the specifics of the industry, but this is in general parlance. The first question, which is really relevant, is what is it that I need to hedge as my exposure? So what is my exposure? When do I hedge? So when is that my exposure is getting triggered? So for any importers who are here today, there can be a different point in time when the exposure can get triggered, whether it could be at the time of placing an order or opening an LC, or when you receive a goods, or when you sell in the local market. So one need to focus on what should be the point of identification for an exposure. And the last and very important question is how much to hedge. Having known what is my exposure, what is it that I really need to hedge? Do I hedge all the risk? Do I leave something open? Or I don't do anything. So it could range from 0 to 100%. Now, this is what a normal importer and exporter will look at when it comes to identifying and managing an exposure. Now, from the experience of being in the industry for last 10 years, our industry is very particular, and a peculiar nature of this industry. And before we even come to exposure management, let me talk about what are the peculiarities of our industry and as it relates to foreign exchange. So the question which is relevant, that are you exposed to FX fluctuations? Are you not hedged naturally? And let's check it out. What are the peculiarities of our industry? First, we have flows of foreign currency both on the import side and the export side. Now, most of our transactions are under matching, and that would possibly make us conclude that we are naturally hedged, and we will check that out in the next slides. But that's one approach, that we are naturally hedged because I have imports, I have exports, and they are all under matching. Entire working capital cycle, if you see, right from buying a stock to a manufacturing to selling to realization, entire cycle is dollarized. This is for most of the companies, and there could be an exception. Now, to facilitate further, RBI has allowed even the transacting between two Indian entities through a diamond dollar account. So you may not export your goods, but you may transact with your local counterparty. Even that is allowed on a diamond dollar. So that actually completes the entire cycle of having a dollar balance sheet, having a dollar liquidity, and having a dollar working capital cycle. And this is how it translates into. So you buy stock which is in dollars. If you're not buying a stock in cash, it could be a credit, but again that is in dollars. So you have a matching stock and a matching liability. Or you could go to the bank and borrow PCFC, which is also in dollars. Once you avail a PCFC, if you had taken an import credit earlier, you will pay that off. So $1 liability offsets the other dollar liability. Then you will manufacture the goods, keep the goods ready. Now the stock which is lying with you is in dollars, and then you will sell it to your overseas customer. Now that is again a dollar asset that you are creating. You will use that to liquidate your PCFs, even that is in dollars. Then the ultimate realization that will happen from your overseas customer, which is also in dollars. So as soon as you get the dollars, you liquidate your liability. So if you really see, there is no non-dollar element in the entire working capital cycle, which may tend to lead to a conclusion that foreign currency exposure is not there for a company which has this being managed completely in dollars. However, the reality is different, and there could be an exception. Now, there could be a multiple combinations of having a non-dollar currency in the entire working capital cycle. So let me give you an example. It could be that instead of borrowing in dollars, you may actually borrow in rupee. There is a rupee PC that you avail from a bank. Even you can have your supplier, instead of billing in diamond dollar account, you can tell them you bill me in rupees. Now just by doing that, we are actually creating an exposure in the entire dollar cycle, and that is something that needs to be managed. Had you been operating on a complete dollar cycle, there's absolutely nothing to manage. But the moment you have any element in the entire cycle which is a non-dollar, is where we end up managing a currency risk. So these are all some of the pointers where the exchange rate risk. So examples being that I buy in dollars and sell in Gunakar. So I will conclude a deal on sell with my local customer by applying exchange rate risk. The moment I do that, it is a receivable which are in rupees and not in dollars. I am exposed to currency. I could buy in Gunakar, so I can buy in rupees, but export goods in USD. Again, that leads to a currency exposure. I may realize in dollars, but I have to pay in rupees because my labors are in rupees. That is definitely a currency risk involved because there is a dollar rupee conversion that happens. I pay my import creditors but borrow from banks in rupees. Most important question, my capital which is invested in the business, is it in dollars or in rupees? Now that's one question which a promoter needs to answer, and there are different versions of this depending on where the promoters is looking at his business. Is he looking at his own investment in the business as the one in dollars or the one in rupees? And that will determine the way he will manage the currency. So even if I am naturally hedged, there could be cases of timing mismatch, and that again will lead to managing a currency exposure. So to simplify this entire approach of exposure management, what we have come up with, and this is being practiced by a lot of companies, to our own clients that we implement this system, is of creating a daily balance sheet gap. Now this is one of the most effective and a very easy to implement tool, which is so very important for the industry like us, where you identify your balance sheet gap ongoingly. Now the frequency with which you will identify your balance sheet gap will be a function of how much volume you do that between these two frequencies. If your daily volumes are huge, then better you do it daily. If you can afford to take a weekly review of your balance sheet gap, then possibly you can do it on a weekly basis. But let me take you through what this balance sheet gap is. So to start with, identify the balance sheet gap in dollars. So there are columns that are there. The first column says your balance sheet elements which are in rupees. The second column is the balance sheet elements which are in dollars. So as I mentioned earlier, if you notice, for our industry, most of the elements on working capital will be in dollars, whether it is a bank finance or the accounts payable. There could be some other non-current liability which could be in dollars. Coming to the asset side, stock which we treated as in dollars, and the receivable which are in dollars. Now once we have arrived at this gap, that is the gap between the dollar liability and the dollar assets, is what will tell us what is the gap that I need to manage. And in the next three columns is what is available is the gap that needs to be managed. So in the first column, if you see scenario 1, the gap is nil and there is nothing to be managed because my entire stock and receivables which are in dollars are financed by the liability and the payables which are also in dollars. So there is no exposure that I am running as of this date, and the things can change as I do my business on a day-to-day basis through various transactions, which may end up resulting in a gap which could be different than zero. So in scenario 2, if you notice, we have $200 of asset consisting of stock 100, receivable 100, that are financed by 125 and 25, which is only 150. So there is a gap of 50 which is financed by rupee borrowings. Now that is something that needs to be managed, because that says that you have availed a rupee finance instead of a dollar finance to finance your stocks. Now if you have done that, best way to manage this exposure would be to hedge immediately as soon as you realize there is a gap, which is the $50. The gap could be on the other side, where you have low fixed assets or low current assets which are in dollars, but which are financed by dollars which are more than the available dollar stock, and that could result into a negative gap. Now this will again lead to a exposure which needs to be managed. So these are all examples of what needs to happen, but important thing is to come to this report, there has to be an internal information system that needs to be created which will give us this report at a periodical basis, because this is a pointer to the currency exposure. So what actions would you take? Whenever you have an excess of dollars SS or dollar liability, you will tend to sell dollar rupee to address the gap or to manage the exposure. And the same is the case with dollar liability being more than dollar SS, we will end up buying dollar rupee to manage the exposure. Once you have started this practice of having a dollar balance sheet gap, what needs to be managed is the incremental change over the base. So today I start to practice this. Then what needs to be managed is the incremental change from today is when I need to then activate my hedge operations, which will keep monitoring that this gap is not unduly large, which will end up having an impact on my profitability. Important element as we manage the balance sheet gap, which is more for liquidity management, which is more for managing the dollar assets and liabilities. Here is a case where we as a company operating in G&J industry are mainly the value additions, providing the value additions to our overseas customers. So we buy raw material, we process it and then export it. So our industry is mainly providing the value additions, and that range could be from 5% to 25% depending on the kind of goods that you are manufacturing, whether it is a large size goods or small size goods. Now that is a real exposure that you are sitting up with, because what you are going to add to your pricing or a product pricing is the conversion of your rupee payment into dollars. So for example, you may have a labor contractor which will charge you 660 rupees, and at today's rate of 66 it would mean $10, which is what you would add to your product pricing. Now imagine if this is not something that you have hedged. Any fluctuation in dollar rupee can start impacting the costing that you had earlier assumed, which is where it is very important that you identify this exposure looking at your own business model. If you are a trader, possibly this is not something which is applicable to you, but if you are a manufacturer, this is definitely something that you need to manage it and include it in part of your budgetary provision, business plan, when you provide for an estimate of your labor. And if you see dollar rupee, there is a premium of almost 6%. So today 66.30, you can have 3 months 67.40, 6 month rate will be 68.40, and 12 month rate is 70.40. Now this is nothing but a kind of a compensation for a future labor hike that you may have. So dollar rupee almost 6% insulates you from the future labor rate hike if at all you may have to undergo. So this is an element of an exposure that needs management, and it needs to be integrated with your own product pricing to really come to a level where you know very clearly as you begin your year that this year my entire conversion is going to happen say at an average rate of 68 or 69, and it could be different for different month. But that clarity will enable you to give much better clarity about how this year's is looking like. So though it's a small percentage of the overall value, but still the fluctuation can impact even that small percentage. Now having identified the exposure, having identified the approach to manage this exposure, the question really is how do you hedge? So what are the various tools that is available for me to manage my currency risk exposure? So there are two main instruments that are available. One is the forward, the other is the future. So forward is something that you execute through your bank, which is called an OTC market, that is the over-the-counter market. Now the features of OTC markets are that as part of the working capital finance limit that a bank would give you, they will also assess how much you can execute under the forward market. So there will be a separate limit for forward market, and there is no margin that a bank would take for you to execute forward contract. What is required for you to execute those contracts are the underlying, and underlying is something which is your import and export invoices or the orders. There is also another way to execute those forward contracts, and that is past performance. So if you are a company which has a track record, last 3 years average exports, average imports can become the basis for you to execute forward contract with the bank without giving any underlying. So these are two different ways in which you can execute forward contracts with the bank. The cancellation is permissible. A lot of restrictions which were there in the year 2013-14 has been relaxed. So it's fairly a free market. You can do with the bank for the exact date maturity. So bank would also quote you for today being 6th May, exactly 1 month from now, say 6th of June, bank will quote you. So that flexibility is available with the bank. Bank will also give you an option period booking. So you can say 1st April to 5th April is a block where my remittances will come in, and you can book your contract accordingly. Let's come to the currency exchange market, which is the future market. Now it has its own features which are slightly different than the forward market, both plus and minus. This market is always and always a margin based. So while the banks will give you a forward contract limit without any margin, at times they may insist for a margin, but future exchange market, currency exchange market will always and always have a margin which is roughly about 3%. In addition, there could be an M2M funding which you may have to do it, which is like mark to market funding in case if dollar rupee movement is against your position. The market is or it is operated through a broker. You have to open an account through a broker, and it is very low cost. So especially the SME player, where the banks would charge anywhere between 2 paisa, 5 paisa, or even 10 paisa, the exchange market is highly cost effective. You may end up paying 1 paisa or even lower than that if you negotiate with your brokers, and even the smallest lot you can trade in the exchange market. So for example, if you go to the bank and say, okay, I want to hedge $10,000, possibly for a bank it's too small a value, whereas here in exchange you can hedge even as low as $1,000. So that flexibility is available when it is an exchange. Exchange markets are not settled through a delivery, it is always cash settled, which means you have to cancel the contract on the maturity, and contracts are all fixed contract for the month end. So you don't have a flexibility to hedge for a particular date. So these are all fixed contracts. Generally, the liquidity available in the first and the second month is very high, and as you move forward from 3 months or 4 months onwards, the liquidity is not that great, which is again a plus for the banks hedging, because in banks you can go even up to 1 year and hedge your exposure, which is not something that is very liquid in the exchange market. So these are the two broader distinctions in the market that we have. Some of the important things that you know as you enter this market and carry out your hedge operations is, and this is something in our experience we have seen it at most of the places, you end up booking the contract for a period of 1 month, and we have seen a lot of companies used to do it earlier, that you would book 1st April to 30th April. Now for an exporter who are generally receiving the premium, this is something which is not very cost effective, because you end up booking a contract from 1st April to 30th April, banks will give you premium only up to 1st April. So consider a case where you have received the premium, or rather your realization happens on say 16th of April, you have lost out the premium for 16 days. So what I would advise is that try and see if you can book it only for a particular fixed date, at best 1 week option period, so that you can take the maximum premium advantage. And if at all you are not sure or certain about when the realization is going to take place, book a contract till 30th April. If 16th April is the date when you realize the money, take an early delivery, which is permissible. You can book and cancel contract without any restrictions. Contracts can be booked by giving underlying or past performance, something that I covered earlier. One important thing that you need to know is, if there are cancellation of contracts for a residual maturity which goes beyond 90 days, there is a regulation that says the banks will be settling those contracts in cash. So if you have a contract which is beyond 3 months, and if you want to cancel it today, any gain or loss will be cash settled in today by applying a discounting rate, which can be negotiated with the bank. So that's one important guideline which you need to know if you are cancelling the contract beyond 90 days. As an exporter, you can borrow in USD, you can borrow in Euro, you can borrow in INR. Now this choice of currency is something which is left to the company, which is left to the borrower, and generally the rule that one would apply is which is the cost effective solution. Now today if you see prevailing rupee rate for an exporter is close to about 10.5% from the public sector banks. The prevailing premium is close to about 6%. So the net cost to you could be in the range of 4%. If the same bank is offering you a dollar finance at say LIBOR plus 200, you would be better off by availing a finance in dollars rather than availing a finance in rupee. However, the government of India, the finance ministry has come up with the incentive called interest equalization scheme. This is mainly for the manufacturers. So if you are a manufacturer and SME, then you can avail 3% subvention. So 3% subvention you can get only and only if it is a rupee borrowing. So you don't get that on dollars, but you definitely get it on rupee. So now compare the same equation. That if bank is charging you 10.5%, 3% is the subvention that you get. It brings down the finance cost to 7.5%. And if it is 6% premium, which is prevailing right now, your effective cost is almost 1% or 1.5%. Compare that with LIBOR plus 200, which you will pay for dollar borrowing. The decision will be to go for a rupee finance. Now, this is one exercise which one needs to do it on a daily basis because there are variables like the premium. 6% premium can vary, plus LIBOR, which itself can vary. So depending on the prevailing rate on a particular day, this has to be under constant watch, which will allow you to save on the finance cost. Now one thing which I want to highlight here is for our industry, though it appears that is a currency risk management, it is actually nothing but the interest cost management. So it is, while it appears that we are managing the currency risk, but currency risk arises apart from the value addition. It arises when you have a funding currency which is different than dollars. And if it is different than dollars, then appropriately hedging would lead to saving of finance cost. And if you are in this export industry and competing with the global players, you cannot have a finance cost which is in excess of 5 to 6%, because then your business will become unviable. Now for that to achieve, you have to constantly monitor and manage both your funding currency, the way you hedge it, the way you manage your exposure, the way you manage your balance sheet gap, the way your systems are designed, the processes are designed, because that will lead to overall minimization of the finance cost. So when we talk about the performance measurement at the end of the year, any businessman would do a business for getting a return on the capital employed. But important question here is, there is an element of a finance cost which has a major impact on your return on capital employed. An effort in that direction to save on finance costs will lead to a significant improvement on the return on capital employed. This is one other performance chart that we have created, especially on assessing a decision that if I am hedging a value addition over next 12 months, whether I would have been better off by not hedging, because there is always a tendency to compare that if I hedge and dollar rupee goes up, then I am losing out. So one thing which we do, and this is a practice that we have implemented at most of the places, is have a comparison. Design your own benchmark. Like for this year, 66.30 was first April rate, and consider that you have hedged all your 12 month value additions at month end by availing a premium of 35 to 40 paisa each month, and you haven't taken any view on the direction on dollar rupee. Then dollar rupee goes wherever it goes, and at the end of the year you would know whether you would have been better off or not better off by hedging or not hedging. So this is a performance for the last year. So if you really notice, because of the way dollar rupee has behaved in the last year, rupee has remained weak. You not hedging last year would have been better off. That's what the chart says, that's what the number says. Because by and large, dollar rupee has been on a higher side. Whether the situation will continue in the current year is something which is a view that one needs to take to decide on the value addition exposure hedging. Some of the relevant terms: interbank rate, the forward premium, cash pot, the margin that you negotiate with the bankers, the matching margin that you negotiate. I'll quickly touch upon the gold hedging, which is similar to a balance sheet hedging in dollars. You make an identical format, the reports for your gold balance sheet. Keep assessing how much is the gold asset which are unhedged, and there are tools available to hedge, which is a commodity exchange. There are companies which have defined some basic capital which are always going to be expressed in gold. So the moment you have a stock of gold in excess of the capital which you are allowing yourself to have it in gold, immediately go and hedge. So stock being more than the capital, then you sell in commodity exchange by appropriately hedging. So these are, and of course the other instrument available is available gold loan. So this is the two way in which you can hedge your gold. I'm not getting into further detail because of the time constraint. This is all that I had to cover in today's session. Quickly about Almus, we are the company which are mainly into the currency risk management, and the details are available in our site. You can visit our site www.almusriskconsulting.com. The key services that we offer is all that I talked about. Implement this system, make sure that you are designed to manage your exposure in much more efficient way, improve the finance cost, and we take up those studies, assignments, we define the risk management policy, go through the research. We have our own in-house research, so that enables you to form a view about the market. We are a team of about 20 people, and a lot of people who are with us comes from an industry background, so we understand the language of the industry. I'm also connected with the GJEPC, Gems and Jewellery Export Promotion Council, DEAL, that is Diamond Exporter Association of India, and being in this industry has been a really wonderful experience, which is what right now we are using to serve the corporates. And these are the team members, these are the core team that we have. Most of us exposed to the industry, either as a banker or as a corporate treasurer. That's a quick snapshot of the core team members that we have. That's it. Thank you so much, and any questions that you may have, please feel free to ask. Okay, so I'll read out the questions and then address one by one. We are into exports and margins are too less. How do I select if you go for full hedging or no hedging? Now, the key question really that you need to answer is, first, what is your exposure? And which is where one of the tools that I covered in our presentation is identify as a start point that are you really exposed to the currency market, and if yes, what is the type of currency market? Is it emanating from the funding currency, or is it on account of the value additions? Having decided that, I would not recommend you to remain unhedged, and also not to take any view in the market, because as you rightly mentioned that the margins are too less. Adding on and taking on further risk in the currency market is the least recommended approach. So best thing would be not to take a view in the market, hedge point to point. But how do you hedge and how much you hedge will be based on the assessment about what the gap is and what the value addition exposure is. What is the difference between arbitrage and hedging? Now, arbitrage is all about the exploring market inefficiencies. So for example, here in India, as I mentioned earlier in my slide, there are two markets where you can hedge. One is OTC, which is bank, the other is future exchange. During times of volatility, both the markets for the exact maturity will show different price. That leads to an arbitrage opportunity. So if you have an access to both the markets, you as a player can always explore the arbitrage opportunity by buying in the market which is cheap and selling in the market which is high. Now this arbitrage can also extend to Indian market and overseas market, which is like NDF market. So there are opportunities that comes up, especially when the NDF market is at a premium or a discount, and you can even explore that opportunity. So arbitrage is a no risk trade where you are only exploring the market inefficiency. Hedging is you have an exposure, there is an underlying exposure, and you are executing a transaction which is mitigating those risks which are arising because of the underlying that you have. So it is a completely two different transactions, one of arbitrage and the other of hedging. The next question that we have is, why is the US dollar so volatile? And now US dollar, and it's not just about US dollar, the world over the currency markets are volatile, and that's what exactly we have seen it since January, that all the major currencies, including all the emerging market currencies, have remained volatile. There are a lot of uncertainties. If you know, the year started with China market talks, like Chinese yuan depreciated. There were rumors in the market about Chinese economy slowing down and impacting big way. Now China has a major influence in today's market. It is sitting up on a reserves which is close to about $3 trillion. And the story that came out in the month of January was that Chinese yuan or Chinese central bank, to defend their own currency, have to spend every month about $100 billion or $200 billion. Now that's huge. Now that will have an influence. So the way today the world market is structured, we are all interconnected. So anything happens in China or US or Europe, it is going to impact each and every market participants. So the volatility is the function of the risk. And today in the world market, there are enormous amount of risk. There has been a monetary easing policy adopted by the central bank over last decade. And we are also seeing an impact of that in the world financial market. And that is all contributing to the volatility. Another important thing that we have seen in the market is the commodity. Like after almost 20 years or 2 decades of bull run, we have seen commodity market correcting. The crude from the highs of $100 plus, we have seen it today at, it went as low as $27 and today at $50. And it's not just with the crude. Each and every commodity we have seen correcting over last few months. Now that adds to the volatility. So market is volatile, and even more important for us to manage the risk that is arising out of this volatility. How to identify and set the benchmark for FX? Very important question, and something that I briefly touched upon, and I'm glad that you have this question for you, because performance measurement benchmark for foreign exchange operation is one of the key elements which helps you to keep improvising your own systems. Now there are different benchmarks that one can take. One simple benchmark is the day exposure is identified for a particular maturity, take the forward rate on that day as one benchmark. Now you may choose to hedge, you may choose not to hedge, but at least that gives you a benchmark that if the decision to hedge was taken on point of identifying, then this is the rate that I should get. Anything else that you do should improve towards that rate. So for example, today 66.50 plus I have 3 months receivable, the premium is 1 rupee, which is 67.50. I may have a view that dollar rupee is going to go up, rupee will weaken, but that gives me a benchmark. The 67.50 is what I need to achieve. So tomorrow, if a dollar rupee goes to say 67, and adding to the premium, if I am able to surpass my 67.50 as benchmark, then I have done well. So that's one performance benchmark. There is another performance benchmark, which is the cash rate prevailing on the date of maturity. So you are someone who do not do anything, and you have an inherent belief that rupee is only going to weaken, and after 3 months, dollar rupee is actually 67.5 plus. Then you may say you have done well by not hedging. However, if it is 67 on the maturity after 3 months, then you may say, okay, I have not done well by not hedging. I would have probably been better off by hedging. So these are two broad benchmark that you can set. There are other benchmarks which are internally designed, which is your budget rate as part of your budgetary exercise. That can be another benchmark that you can set for your forex hedging operations. The next question, can you share some views to avoid or minimize transaction risk? So transaction risk is the one which arises from the import and export. It's not trade transactions. So one way to manage, so you can't really avoid. So the question, let me repeat the question. Can you share some views to avoid or minimize transaction risk? Well, you can avoid transaction risk by billing in the local currency. That is the simplest way to avoid transaction risk. So if you have an overseas customer, say I'll bill in rupee, then there is no transaction risk. The fact that you have a transaction risk because the exchange rate or currency is different, you will end up minimizing it. Minimizing risk would require you to hedge appropriately for the exact maturity, taking no risk. So not just minimize, you can completely protect by hedging point to point. The next question, to get in options, what is the minimum amount required? So for exchange operations, which is the future market, future and option market, the minimum lot size is $1,000. However, for banks, there are no restrictions, but if you go to the banker, anything below $500,000 or $1 million for an option price, banks will not really give you a very efficient price. So for a banking as a counterpart, OTC market, only and only when it is minimum $500,000 to $1 million rupee or dollar equivalent, you would generally go to the bank to get the better price. The next question, does hedging against gold rates work on a similar principle to Forex? Yes. So as I said, if you are into jewelry, if you are into buying and selling of gold or jewelry, then definitely hedging would be an identical principle. The principles of hedging is similar. Anything that is fluctuating, you want to hedge. Now gold, having already bought gold and you are exposed to the fluctuation of gold rates, it would work exactly similar to the way Forex market would work, and even the hedging principles are identical. The only difference is the counterparty that is available for your gold rate hedging. In case of gold, it is multi-commodity exchange, or if you are an international player, you can go and hedge in COMEX. Dollar rupee, you can go to the bank and hedge, or you can go to the exchange and hedge. So those are all the platforms that are available for you to hedge. The next question, is it advisable to invest in gold as a commodity in the current volatile market? Yes, if that's how you are planning your investments, and having a gold as one of the diversification in your investment portfolio is always recommended. So depending on what percentage of diversification you want to do it, gold is a good investment to have it in your overall investment portfolio. What is the major impact on rupee on the Fed cutting, increasing the interest rates? Fed cutting or increasing the interest rates has both pros and cons. So the way dollar rupee would behave, so take a case of Fed cutting it. Now whenever USD or Federal Reserve will cut the interest rate, that will lead to a monetary easing across the world, and that leads to the incremental amount of flows which can come to the emerging market. Now that's one set of beliefs, because that's how the market would react. At the moment you have an easy monetary policy, then all the emerging market equities or the bonds would suddenly become very attractive. So it would lead to the inflows in the country, which will help rupee to strengthen. Same way, if there is an increase in the interest rates by Federal Reserves, the tendency is that the funds would become scarce, and hence the incremental flows in the market would tend to reduce, and which may lead to a bit of a rupee weakness. However, one thing which we need to understand, and that is again I am going back to the first chart that which I presented, is the way Reserve Bank of India has been managing dollar rupee. Because if you look at the fundamental of our economy, we are net negative on the trade front. So we are more as an importing country than an exporting country. So generally rupee will, or any currency would appreciate along with the trade flows, because capital flows at the end of the day are your liability as a country. So generally Reserve Bank of India, or for that matter any central bank, would not be comfortable letting the currency appreciate if it is due to the capital flows. So say for example today there are huge FDIs that come in, or there are FIA flows, stock market just goes up. Reserve Bank of India last consistently over a few years has adopted a practice of not letting the currency appreciate. So during that time, invariably Reserve Bank of India will be there to buy dollar rupee, and that gets reflected in the reserves. So if you see reserves today, it is $360 billion versus what was there at $280 billion almost 2.5 years back. So letting the currency appreciate on the fundamentals of more exports than imports, yes, but not otherwise. So these are the pros and cons of the flow management that the central bank or the regulator would adopt. that will help rupee reflect more of the real values than the speculative market would decide. So that's something which gets reflected. Then yeah, I think we don't have any further questions.
I think we have around 5 minutes more. We'll wait for a minute and see if you have any other questions. You can please post into the questions panel, and we would be happy to answer them. And we'll wait for a minute, and then probably we'll see if there are questions. We'll take it up, or else we'll close the session for today.
So as we wait for the questions, I would like to thank once again each and every participants. I know it's been a working day, and 2 to 3 is right at the the peak time. So you all have been scheduling yourself being here completely for 1 hour. Being a patient listener and a participant really means a lot. So thank you all so much. It's indeed an opportunity that I have. It's a privilege for me to share what I've learned over a period of time. And Maulik, along with the entire Almus team, remains grateful to each and every one of you. And thanks really to GemAtlas for creating this wonderful platform for expressing our views, sharing our knowledge. That really helps each other. And in the meantime, you can keep posting your questions. You also have my email ID, my contact numbers. Feel free to talk to us, write back to us, any views, any questions that you may have. We have our own internal research, which is headed by one Mr. John Matthews, regarded as one of the very well-respected research analysts in the currency market. There are reports that he publishes. So if any one of you are interested in subscribing to those reports, that gives you a guide of where the world is moving, be it commodity, currencies. You can write back to us. So here is a question: where do you see the dollar heading, north or south? Okay, so I was waiting for this question. I was surprised how come it didn't come up so far. What about interest rates? So dollar, our view is dollar rupee at around 66 level has got a decent support from RBI. We possibly can, in the near term, we may go up first. However, we don't expect the rupee weakness like last year. So at best it can go to 67.5, 68, and from there it can turn down. There are a lot of event risk. June, July is where there is a Brexit Britain exit talk that would come up. After that, we have a major event in September where $34 billion of FCNR deposit, which was availed in 2013, is something that is coming up for maturity, and it will not be renewed, which will have an impact on the market. Though Reserve Bank of India is well prepared in terms of higher reserves and higher forward contract book already hedged, but still it can lead to market volatility, and in that market volatility it can trigger even towards 68, 69. So we don't expect the earlier highs of 68.5 or 69 to be taken off. So on the long term rate, please, the exchange rate maximum it can go to 68.5, 69, not beyond that. On the interest rates, we have the Fed market, which is the Federal Reserve, which is fairly, have indicated that they are not going to increase the rates, though they started in December. We possibly may see a year of no rate hike, though there are expectations after second quarter or third quarter, but we don't expect the US to increase the interest rates. The local market rates can go down, and there are cushion available for us, and Reserve Bank of India may, depending on the monsoon, as they have said, can cut the interest rate. What about yuan? So I think Chinese market, after initial panic in the month of Jan and February, has settled down, though the inherent risk remains. Commodity market, if you see off late, has stabilized from a bottom of what we saw in crude is now almost $40. So Chinese market may not pose the risk as it was perceived in the month of January and February, but however, as far as China is concerned, it continues to be a black box. No one knows real story behind Chinese market. So that's something which is really a big question mark, and we'll also look forward to having some clarity in that market. And yuan has also stabilized along with the market. So since the initial weakness in yuan, I think that's off late. The data was the forex reserves has not dipped, so we saw positive Chinese in the Chinese economy. So that's one good news. US election is another big factor which will create the volatility. So be prepared for the volatility. That is all that I have to say, and make sure that your internal systems and processes are strong enough to really manage the volatility and protect your business. All the very best. Wish you very good luck for the coming financial year. Over to Swapnil.
Thank you so much, Mr. Shah. On behalf of GemAtlas, I would like to thank Almus Strides Consulting and Mr. Shah to have this very informative webinar for us. We look forward for many more sessions of this type in the future. To all participants, if you have any queries, if you have any questions that you have on this webinar, you can write back to us on the email address that is being displayed on the screen, or even on info, that's info@gematlas.com. You can connect back to us. Thank you so much for participating in today's webinar.
Thank you all.
We end the session now. Thank you so much.